Good morning, everyone. This is Rob McDougall from Zhang Financial with your weekly economic update. Today is Monday, February 20th. We're going to go over last week's economic data as we always do, talk about returns in both the fixed income and equity markets, and then preview some of the economic metrics coming out this week. So last week we had two major inflation metrics, both CPI, CPI core, and PPI come out. Also had consumer spending information, update on retail sales, and housing updates. So let's go through those. So last Tuesday we had the CPI, very critical, both the CPI, PPI, and PCE, which is this week. The inflation measurements, we've talked about how important it is to see these metrics continue to drop. Well, in terms of the CPI, it did drop last week, but not as much as economists had expected. So the CPI year over year came in at a positive 6.4%. The good news is that's the seventh consecutive drop from the highs back in June at 9.1. However, consensus was 6.2%. So disappointing on the inflation front, at least on the CPI. The month-over-month increase was 0.5%, higher than expected, and the reason why, shelter costs were higher than expected month of January. That shelter costs are more than, it's almost a third of the CPI basket in total, so just small changes in that does move the index quite a bit. So that was the variance from expectations. And the economist's expectation going forward is that maybe just a one-time aberration, so that is not expected to recur. So I think the disappointment in terms of the CPI not coming down as fast as many economists thought, probably temporary. Also, the CPI core came in. That was a little higher than expected as well. It came in at 5.6% year over year. That's CPI minus food and energy, came in at 5.6 versus the 5.5% consensus. The producer price index that was released on Thursday, that also came in higher than expected. Again, seventh consecutive monthly drop. That's great. However, it came in at 6%. The expectation is it would drop to 5.4%. The disappointment in the PPI numbers wasn't housing related, but it was energy prices. So energy prices were higher than expected in the month of January. So it drove the PPI up, a little stickier than it should have been. The good news within the PPI number from last week is that food prices still really high, but the increase moderated. It came in year over year plus 11.6%. That sounds high, and it is high. But that is the smallest increase we've seen since October of 2021. So that's moving in the right direction. Last week, we also had retail sales. Now, this is one of those good news is bad news because investors are so focused on inflation and anything that will drive inflation. Retail sales, much stronger than expected. They were expected to be up month over month. We had two consecutive losses the prior 2 months, negative 1%. In November, negative 1.1% in December. It was expected to be up a positive 1.7% month of January. Actually came in 3%, 3.0%. And same for retail sales ex-auto, stronger than expected, came in at 2.3% versus an expected 0.8% increase. Last Thursday, we had January U.S. housing starts. The actual came in below consensus. It was 1,309,000. The expectation was 1,355,000. That represents the fifth consecutive monthly drop. And building permits also came in a little below expectations, 1.339 million. The expectation was 1,350,000. That seems to have stabilized a little bit. Last 3 months have been pretty much flat, so I think that is potential good news with building permits leveling off. So all that information last week, what did it do to expectations for GDP growth, inflation, Fed moves? GDP expectations, again, we use the Atlanta Federal Reserve's Fed Now. They update that quite often weekly, sometimes more. Last week, they increased expectations for first quarter U.S. GDP up from 2.2% to 2.5%. The reason they cited was actually the housing start information that was better, less negative than expected. So inflation expectations, despite the fact that I told you both CPI and CPI core and PPI were worse than expected, the inflation expectations barely budged last week. It was up 3 basis points, so it moved from 2.33% to 2.36%. So obviously investors were not fazed by that too much by that CPI and PPI shortfall to expectations. So how about the Federal Reserve? Well, the expectations now for the next Fed meeting, which is March 23rd, the expectation still is a 25 basis point increase, but the odds of a 50 basis point increase rose last week. So the probability had been roughly 90% that we would see a 25% increase, 25 basis point increase, 10% that we would see 50 basis point. That 50 basis point probability rose again from 9%, it doubled, so it is now 18% probability of 50 basis points. So lastly, we'll just touch on S&P earnings, which again is a key driver to equity returns, particularly later this year. Expectations have fallen both for the fourth quarter numbers that are being reported now and for the full year 2023. So 82% of the S&P 500 companies have reported so far their fourth quarter 2022 numbers. 68% of the companies have beat consensus expectations. That sounds good, but again, the 10-year average is 73%. So clearly, pressure on S&P earnings in the fourth quarter and below expectations. For the full quarter of fourth quarter, again with 82% having now reported, the expectation is S&P earnings will drop 4.7% in the fourth quarter of 2022. And the full year 2023 estimates have come down slightly. Again, the expectation now for full year 2023 is that S&P earnings will grow 2.3%. So despite the fact you hear consensus expectations have come down, that's actually probably a good thing. With expectations down, if U.S. corporations are able to beat earnings as they historically have, it will be a very positive metric for the stock market. Lastly, valuations on the S&P 500, again with earnings, a shortfall, or I should say negative earnings growth in the fourth quarter. The forward price to earnings ratio on the S&P 500 is 18.0 times, just slightly above the 10-year average at 17.2 times. So the response to all that economic data from last week, again, I think kind of disappointing inflation news and better than expected economic growth news. The markets hardly moved in total. So the S&P 500 last week was slightly negative. It was negative 0.2%, so roughly flat. Within that, we always bring out or often talk about growth versus value, small versus large. Growth last week outperformed value as it has year to date. Growth was up 1.1%. Value was down 0.1%. Small cap, which has outperformed large cap significantly this year. Small cap was up 1.4% last week. Large cap, negative 30 basis points. So international markets, we'll just call that roughly in line with the U.S., so not much to speak of there. We'll talk about fixed income. Fixed income returns negative last week. The inflation news, again, being a little worse than expected. 2-year yield, the U.S. Treasuries was up 10 basis points. The 10-year was up 9 basis points. So the U.S. Bloomberg U.S. Bond Aggregate Index last week was a negative 0.5%. So economic news coming up this week. I'll just rattle them off. Starting tomorrow, we have existing home sales. And then on Friday, we have a slew of economic reports, personal income, personal spending, PCE, which is going to be very critical. Again, personal consumption expenditure, the Fed's preferred metric of inflation. We have new home sales, and then we also have the University of Michigan Consumer Sentiment Index. So we'll go through them real quick. We'll throw up the slides as well. January existing home sales, the consensus is 4.12 million for January. So if this does happen, that would be an increase month over month, and it would be the first increase in existing home sales in 11 months if it does happen. Then on Friday, again, personal income, this is expected to be up significantly. This is a very significant increase if this does occur. Consensus expectation, personal income up 0.9% month over month. It was up only 0.2% in December. So if we do get that 0.9% increase, that's going to be the highest increase we've had since the beginning of COVID and the disruptions with that. Then you have to go back 2 years prior to that to get a month-over-month increase of 0.9%. So personal income looks like it's moved up very sharply in January. Same thing for personal spending. Personal spending is expected to be up 0.9% month-over-month. That, however, is coming after 2 consecutive months of actually negative personal spending, negative 0.1% in November, negative 0.2% in December. Personal consumption expenditure, I believe this will likely be the most significant news item of the week economically. The expectation is PCE to be up month over month by 0.4%. The month of December, it was only up 0.1%. Now, I say this is going to be likely the most important metric. However, given we saw both CPI and PPI coming in worse than expected, even if this comes in a little worse than expected, I think investors are probably conditioned for it. So, lastly, our 2 more metrics, January new home sales. The expectation is we'll actually see a very modest increase over the month of December at 620,000. It was 616,000 in December. That would be a positive again during the whole year of 2022 with all the Fed rate increases. By far the most impacted industry that we've seen has been housing market in the U.S. We're now starting to see some stabilization and actually some improvement in some of the early metrics. So it would be good to see new home sales actually up on a month-over-month basis. Last metric this week, it's the February University of Michigan Consumer Sentiment number. That has been coming up over the last 3 months. We're at levels that we haven't seen since last April. Great. The expectation is it is going to be roughly flat. So the month of January was 66.4. Is expected to come in for February at 66.6. So, a busy week. That's all we have on the economic and index return side. Thank you very much for attending. Look forward to seeing you next week. Thank you.
Wow.